Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in.
Wes, it's so great to have you on. Thanks for being on.
You're welcome. It's nice to be here.
I always like to start with just hearing about people's journey, and I've known you for a little while, but if you could share with the audience kind of how you even got from the world of consulting and international development to becoming an allocator.
Absolutely. I feel like it's common in venture, whether on the allocator side, the investor side, that everyone has a quirky and maybe non-repeatable path in. I think I have reflected on my family dynamics growing up a lot as a huge driver of my path into venture, and particularly the LP seat. My father is from rural Utah. He grew up in sort of a conservative family that instilled in him, like on a farm, values of thrift, hard work, kind of a market-oriented mindset. Think like Mitt Romney vibes. Mm-hmm. My mom's family is very different. They are a family of immigrants from New Zealand. They're Maori, a strong connection to the land and indigenous tradition. They instilled in me kind of more of a progressive, if you will, orientation, view of the world, a sense and view that markets don't always work for everyone. So I always, when I started my career, had this deep interest in trying to make markets work for everyone. Mm-hmm. And started my career in consulting as just like the first place where I could see a bunch of businesses, see a bunch of things in action, figure out where to go and how to find the places where I could maybe be part of trying to make them work more for everyone. And so I went from consulting to international development to venture to the LP seat. And the through line was really about trying to get closer and closer to the people that were really building things. So as a consultant, I spent a lot of time with large companies, and then at tail end did a couple of projects with small nonprofits and a couple of startups, and was like, that's where I need to go. International development then kind of put me closer to small companies and startups that were building a range of things in tons of different sectors like healthcare, ag, etc. And the sort of philanthropic at the time bent of that work really felt stymieing and slowing at times. And so I got interested in venture, moved to the Bay Area to work in 2016 at this small impact-oriented venture fund called New Media Ventures, where I was really spending a lot of time backing seed stage and some pre-seed stage companies in these very niche spaces. So civic tech investing, ed tech at the time, some media companies before media was like not logical for venture. And I loved that work, but I found myself most of all really loving the people and the other components of what was required to be good in venture. I just felt I wasn't as good at or didn't have as much passion for. And so some of the GPs that I had met in that seat while I was at New Media Ventures, I caught wind that they were starting Screen Door, this fund of funds. And it occurred to me like this was a more kind of narrow version of looking for people that were building things. The thesis was kind of underrepresented or misunderstood GPs, but that the way you look at a GP compared to businesses writ large was much more people focused and much more about building conviction in whether or not I really believed a GP or any individual person could really execute a strategy and that they were right for that. And that felt like a light bulb moment. It's like, that's what I've been looking for.
What assumptions did you have about this idea of like emerging managers and people building their own firms? And then kind of, once you're in it, which assumptions kind of were validated and which were kind of like, oh, I definitely didn't know anything about this?
I think coming in, I had really not seen the traditional LP side at all or thought about that side. So I had just this tremendous blind spot around what LPs are, how that shapes like a GP strategy and the type of things they may spend more or less time on, and the fact that GPs really have, in a way, two customers, LPs as well as founders. And so a lot of it was an exercise in assuming that so much of my diligence and focus would be kind of one playbook, like you are a SaaS fund and you do this type of thing. But within the universe of any type of funds, thematically, there's a whole LP side that I really had to learn. And so I I think what I found going into Screen Door was that there's not one playbook to win in venture, and that as a GP, it's such a bespoke per fund mix of ability to speak to founders, charisma to raise, long-term vision coupled with like short-term execution and like sort of markers that convince everyone in that whole universe that like you're worth backing and supporting. And that was like a very different motion than, do I think the business model of this company is in a big enough market with like the right product? So those are some thoughts that come to mind.
You talked about being motivated to find how capitalism can work for everyone. Is that at all related to where you found yourself today?
Yeah, it's a good question because it definitely is. So today I find myself at the Astera Institute. We are a multi-billion-dollar foundation. We have a mission to steer science and technology towards an abundant future for humans. Our view is AI is accelerating, it's coming, and this will present a variety of futures for humans. And so we have an urgency to back deeply technological and frontier science-driven projects that really help humans flourish and thrive. And so I think to your question, when I learned about that, both that mission as well as the way that the foundation intends to operate, which is kind of a mix of the flexibility of philanthropic dollars and being able to structurally and thematically invest in a lot of different things, but with the kind of the urgency and the speed of a venture fund, it felt like this is the type of place where I can do that type of work.
And you've recently, with the addition of you to the team, added fund investing to the mix. There's, you said the grant making, the research. How does that sort of Screen Door fund of funds approach fit in? What's it doing at the foundation?
Let me give a little bit of context about some of the things I saw at Screen Door that kind of led me, and then how I got to Astera, because I think that'll frame up a clear answer to your question. Screen Door was a wild experience because I joined as the first hire, and for those who may not know, Screen Door is a fund of funds that was started, I joined in 2021, so it was started then by 10 GPs that came together, who had all built their own firms, were very known, Satya at Homebrew, Kirsten at Foregreen, folks like that. They had this thesis of, we can uniquely back, know, and support new GPs in building their firms. And the set of LPs that we had at the time were deeply institutional, some of the top endowments, foundations. And so it was this unique coalition of people that crowded in, like on day one, GPs who wanted to talk to us. And so when I joined, my job for the first couple of years at Screen Door was basically just talk to every single GP all the time. And so I think I remember showing up my first week at Screen Door, and the team had put like a boilerplate intake form on the website. Hey, if you're interested in pitching us, send us an application, send us a deck, without knowing really how much inbound we would have. And I think on my first day, we had like hundreds of applications. And the GPs were like, can you just sort through this? Which was a daunting and exciting process. And I was like, sure. So all this just set the context of like, I just saw such a flood of GP decks, pitches, approaches. Some of this informed my mental model quickly around like, okay, there's really not one way to win. One thing that I saw at the time was, I saw there was like this sliver of deep tech funds that were raising in 2021 that just personally felt more interesting. Again, kind of it's not a knock on SaaS or anyone that truly loves it, but I just always think of that as the example where I remember seeing decks for GPs wanting to invest in neurotechnology or fusion and geothermal, and just thought that was interesting, but it wasn't really a space we were looking at Screen Door, which made sense at the time. Some of the model was like match people that have built firms with up and coming GPs that are building firms where that experience makes sense. And we just didn't have as many deep tech GPs around the table. So fast forward a few years, and as I was just thinking about and continuing to talk to hundreds of GPs every year at Screen Door, I just noticed there was a steady trickle, but it was noticeable, of more and more quality technical GPs. And they all had like shared characteristics. Many were scientists. Many had academic networks or theses that didn't translate well or wasn't easily understood by larger institutional LPs because they don't spend their time there. And I started to feel like we were kind of missing things. And I remember at one point, towards the end of my time at Screen Door, making like my own list of here's like the 5 to 10 funds I've loved the most that like we just haven't spent any time on. They all kind of clustered around deep tech. So all this to say, I met Astera and realized that like this is the type of institution that has the flexibility, the capital, and the network to understand and make these GPs legible, give them early commitments, and really help them. So there was an automatic click in my mind around the type of capital and the GPs that I was seeing in the space. And then as I learned more about Astera's mission and about some of the structural benefits of investing in funds, it seemed like a no-brainer.
I spoke to a very well-known multifamily office that is starting to incubate funds. And so it made me think of this question. When you do have that opportunity, you're coming together, you're meeting Astera, like how do you convince, and then implement a blank slate kind of incubation of kind of an allocation strategy?
I like and appreciate thinking about this because it's all I've thought about for the last year. And so there's a lot of pieces. Maybe at the high level, I would say, the thing that I've tried to do is really think about this as a trust building exercise. And the kind of structural components of building that trust for me have been first painting a long-term picture of, should this succeed, what can this really unlock? In the same way that GPs often pitch to LPs, like by fund 2, 3, 4, like this is what you will see and what you will have. But couple that with like a very narrow, right now, here's exactly the contours of that and what I will do. So to maybe be more specific about that, I'll just tell you, when I first met Astera, I had left Screen Door. I had been looking for my next role, which was a long and intentionally picky process for me. I wanted to find the right fit. And Astera at the time was looking for what is now my colleague Eli Dorado's job, which was the head of strategic investments. So sort of his point on startup investing, grant making, I do funds, we kind of collaborate on both. And I interviewed for that job, having done grant making and startup investing in the past. Astera told me, hey, we think that someone else is better qualified for this. And they were right. But we like you, and there's something interesting, and you keep talking about funds, like what is this? So the way tactically that I started at this was I told them, what if you just contracted me to build almost like a research paper in the mode that a scientist would, because this was kind of the currency and the language internally, where I'll go out and scan the landscape and really give you proof points qualitatively and quantitatively around how many of these funds exist, what they're doing, the profile of these, if we were to back them, what this would mean for our network and understanding of different nodes of research going on that we might not have purview into now, different types of company that might be mission-aligned investments that we would want to make, et cetera, et cetera. And so I spent a few months at the end of 2024, just as a contractor, like building that thesis out and saying, here's like the rough contours of what a internal process or program build would look like. And the first step was just getting the buy-in that they thought this was like a worthwhile experiment to run. And it was more about like shaping the experiment. One of the operating principles at Astera is think big, look for underserved ideas, and like do the experiment. So a big part of that, to your point, Ernest, was like there is a motion in the field of like people incubating these things. And I see it less, I remember talking about this, I see at least in this space, and I see us as uniquely positioned to do it. And at the time, Astera had only been around a couple of years. We're kind of under the radar relative to our ambition and also how much capital we have. We have like multiple billions of dollars. So that was step one. And then that painted both kind of the value of doing an experiment and the macro possibility here. And then in the micro, because I imagine many listeners might imagine this kind of nerdy thing, I really try to back into, if I was starting my own deep tech fund of funds right now, what is the sort of max amount of capital I would feel comfortable raising and deploying, and what would year one look like? And so I thought about it like a normal portfolio construction, very much like a traditional allocator, and kind of map that out. So year one, I'll deploy somewhere between 10 and $15 million. I'll back 4 to 6 funds. I'll sit in the LPAC for a few of them. I'll do this type of check size. So all those mechanics were there. And then year one became about really just executing that and like overly communicating. I think compared to now, what I will start to do, everything I was doing.
Now we're going to take a quick break to speak with our sponsor.
What regulatory changes should be on the radar for VC managers who are listening?
So I think folks really need to be thinking about this in the context of the overall environment that we're in right now with the SEC and its focus, and really a shift that has occurred over the past couple of years and with a new administration. That doesn't mean that private funds are off the radar, not by a long shot. That there's still a primary focus for the SEC, and so I think regulatory change is going to come in the form of a little bit more of a focus on core, kind of the core values, if you will, for the SEC and for fund managers. How do you run your operation, right? The anti-fraud principles always have and will be part of the framework that a VC manager needs to live with, right? So when you think about it from that perspective, things aren't really changing so much as bringing that focus back to core elements as opposed to what we'd seen the past several years, which was almost the flavor of the week, right? What area of regulation is going to get specific focus today? We're much more to core fundamental principles of anti-fraud, under which marketing rule falls, right? And a lot of the principles around what do you say about yourself? How do you say it? What materials are you putting out in the marketplace? What are you saying to LPs, right? All of those components of communication through your offering documents, through your promotional materials, they all have a foundation in those anti-fraud principles. The SEC is back to those core values, if you will, and I think that this is an opportunity for managers to reset around that same set of core values, right? How do you think about the product you offer, the way you offer it, what you say about who you are and what you do, right? With that framework in mind. So there's definitely some marketing rule flavor there, and folks who've been in a regulated environment or in a regulated entity will say, wait a second, that sounds a lot like the marketing rule, and we're not registered as VC managers for the most part. So kind of speaking to the ERA unregulated space,
Yeah.
we're not subject to the marketing rule. So why does this kind of sound a lot like marketing rule? Marketing rules really, it's based on the anti-fraud principles and things that had developed through no action letters and enforcements over 40 years. And then they wrote the marketing rule kind of building off of those principles. So if you know that the SEC is looking at this through an anti-fraud lens, look, they wrote that rule through the anti-fraud lens. So you really want to come back to those kind of core values. There are a couple of other things that have similar focus, right? So valuation, a lot of VC investments are going to be difficult to value illiquid assets. Same thing. There's a core set of anti-fraud and kind of fiduciary principles that are built around the valuation process. And those apply equally to VC ERA managers as they do to fully registered RIAs. And so that's another space that I think managers should pay attention to. And then lastly, I'd say it's really just conflicts of interest, which has always been in front of the SEC for this type of manager, for private fund managers. So just kind of, again, thinking about where do we have conflicts of interest? Where do we have things that we should be telling our investors are areas of potential conflict? What kind of governance structure do we have? Do we rely on an LPAC, advisory committee? What does that transparency look like through that governance structure? I mean, those are things that we would think of. I drop down one additional layer, which is that's all kind of at the federal level and what the SEC is doing. We've been seeing states become much more interested in regulating parts of this environment where they can. We have federal preemption, which prevents them from really going fully into regulating these entities, but states have been more active, and I think the CFIP and the California reporting for venture managers is an example of that. So pay attention to what's happening at the state level as well.
It's fascinating. So we've got the communication. You're keeping an eye out for communication rules, valuation rules, conflict of interest, and also where you're playing, what state. On the valuation front, any shorthand guidelines you can give us? Anything that just to keep in mind?
Right. So yeah, I think it really for the SEC, they really like to see process and then consistency with process, right? So, all right, that's great, Chuck. What does that really mean, right? So what are you going to do with that? So you're going to have a number of different types of assets. You're going to have different valuation procedures and how you're going to value different types of businesses. But they're all going to be built off of what I would say is a similar model and framework. And that's really where you start, right? Like what's common among the things that we do across the types of businesses that we invest in. And that really becomes the core of your policy. These are the things we do in the broadest strokes possible. And then following that process and identifying where we need to do something differently, right? So it's really this kind of waterfall kind of workflow type of arrangement where you identify these are the things that are common across all the valuation exercises that we engage in. These are the things that are different because it's a different sector, it's a different frequency, there's a different valuation model. And those become the jumping off points to then call out the exceptions or differences across those so that you really have a core set of documents, of processes, of things that you can point to where you've engaged in valuing that asset in a way that you can say, look, there's familiarity here on how we do this in order to get to the number that we're attributing to this. So do that with a third party, do that internally based on a combination of internally and externally derived data. Do that in a number of different ways, but before you engage in that process, say what you're going to do, right? Like if you've explained that this is how we do things, and then you do it that way, that takes a lot of the mystery out of it. It takes a lot of the question that the staff from the SEC has about, so why did you end up here, and how is this not you putting your thumb on the scale and saying it should be this or that? You've identified before you get to that point the way in which this should be thought of as a reasonable exercise, right? And then you execute against that. And where you deviate from it, you're going to say, hey, look, without knowing where we would end up, this is the path we thought we would follow. But we had to deviate, and here's where we deviated and why. And with that type of record, it helps support the reasonableness of the manager's valuation exercise and how they chose ultimately a value to assign among a number of different reasonable outcomes.
No, it definitely feels like this SEC is treating venture capital like it's time to grow up a little bit. Interesting.
I think that's fair.
Any global regulatory trends that we should be aware of as venture capitalists?
I think what you're seeing here on a global stage is kind of a convergence of several different regulators thinking about the venture space in the same way they have other products. And if you go back in time and you look at how globally different regulators around the world have kind of converged on a set of standards for the marketplace, I think you're starting to see that with venture capital as well. I think there's a greater understanding or deeper understanding that is developing across the marketplace, I should say across the regulators on the global stage, that has them applying the types of requirements that you would see for different asset managers and private fund structures, private equity in particular, that really applies kind of a stricter standard to these managers. And I think you see that kind of both with the EU and UK and to other places around the world, that they're really kind of drawing these managers into this more strict standard and doing that in a series of steps that brings them really into this global marketplace under the more strict regimes that you have in place for different private fund structures. And I think one part of that as well. And sorry, I had another point, another note that I made there. So let me start that one again. Um, One difference that you'd see on the global stage is from a US perspective, the SEC kind of stepped away from ESG and greenwashing. It was a hot topic for a while. Managers were very sensitive to it. The SEC was running around doing sweep exams. If they saw the letters ESG, they really wanted to know what a manager was doing there. And they've kind of backed away from that a bit. Like, you don't see that level of interest from the staff. Still out there, still a question. You still pick that up in an exam if you're a registered advisor and you have that stuff in there. But the rest of the world has continued down that road in a way that the SEC hasn't. And I think if a manager is starting to think about their operations as more of a global footprint, a global enterprise, and they've been operating in the US and they've seen this kind of pendulum shift or swing on the ESG, I think they'll be surprised to see it's still a significant area of interest for global regulators in a way that it's kind of faded a bit for the SEC.
Oh, that's fascinating. Because I also feel like the dollars have also faded away in addition to the regulation. Interesting. You have been described as the Elvis of the legal regulatory community, Chuck Daly. And I would love to hear what your team at Sidley does so people know how to find you.
Yeah, absolutely. I guess I should say thank you very much. I haven't come across that description very often, but flattered to be called that.
The king, yes.
So, I mean, look, I mean, the Sidley practice, I mean, what really, I think, makes us stand out, it's not just, there are just some fantastic individuals who are part of the group. And you know, when managers, GPs are thinking about, you know, who am I talking to about my fund structure, I'm thinking about launching another vehicle, I'm thinking about doing a deal, you know, there are a few folks among the Sidley partners who are kind of standouts in the VC space. But that's really just, that's the headline, right? Like that's the person that has the relationship. What's great about Sidley is the rest of the group that they have access to, right? The rest of the partners. I mean, we're very deep across so many different areas. It doesn't matter what a VC manager would be investing in from an industry or sector or type of business. We probably have someone who's an expert in that particular business, you know, across our corporate group or in M&A or from a tax perspective. I mean, what's great about the Sidley family is how deep we are in so many different areas, and we are accessible to one another to do those things. You know, if I have a question about, you know, hey, what's happening in the VC space, I'm going to call Shane, right? Shane, what's going on? And he's my access point, and vice versa. If he has a question on the regulatory front, he's calling me.
It's an incredible talent pool. Yeah. Thank you.
And now back to our LP interview.
So making sure that you're already ahead and you're starting, you know, utilizing all that expertise and that knowledge that you've had from prior places. That's a good reminder. Was there anything, you know, going from a fund to fund to a foundation, a lot of differences, but I was curious if there was any kind of like, because of the goal and mission of the foundation, has it changed anything with like the risk appetite or time horizons for you with your investments?
The distilled answer is we're just much more flexible, which personally makes me energized, and also, particularly in the early days, makes it really challenging. I think I joined within a month of my colleague Eli joining, and we're the two-person investment team. And the backdrop of Astera this first year, because I guess I've not even been here a year. I guess March will be about a year. So the backdrop these first 10 months has been building and reshaping the team very quickly. That includes a much broader set of researchers, and then figuring out from this broad mission of deep tech and frontier tech, what are some of the key areas we really wanted to focus on. So I think there was a lot of what about this, what about that, what about this, what about that motion early, where I was trying to just figure out thematically like where to hunt. Once we started to coalesce around some things, then to more specifically answer your question, I think the biggest difference is anytime I start to really get to know a fund now, I feel like I am needing to, in a bespoke way, paint for myself what the potential value of backing this fund is from like a first principles perspective. Whereas at Screen Door, it was so much more like, I know what we're looking for, and it's more about like, can this person do it uniquely? Like we are looking for maximizing returns. And at Astera, if I think about the 4, maybe soon 5 funds I've backed so far, and the host of co-investments and startups that I've also like worked with Eli on, I can like the story for every single investment is very different. Some are so that we can just see a lot of deal flow and co-invest with a fund, which we've done. Some is because I think we can be the most valuable LP, and that will get us into different research networks in a way that we couldn't. On the startup side, last year we did like a pre-seed or seed company in a couple of contexts, and then we led the Series C of a small modular reactor nuclear company. So it's really opened the aperture of what we can do, and I love it. And the challenge is, for me, it's made it less straightforward for where to spend my time and what networks to build, who to pay attention to. And I think I'm still working through that. But we're shockingly flexible in terms of what we can do and what we can invest in. I never want to throw good money into bad things. So any fund I back, like I have to make sure I feel real conviction that at least it will return a 3x or something.
You mentioned networks. Are you are there any things you can mention that you feel like are deep tech or frontier tech great LPs that you're sharing deals with, or great communities, if other LPs listening are interested in kind of joining you in this space? Maybe it's, for SaaS, it's like the Waterloo graduates, or, is it all just SpaceX people?
Yeah, this is a good question, because my take on this is like, you're starting to see that, but it's not as obvious or kind of coalesced yet. Not to beat the dead horse with some of the Screen Door comparisons, but I remember at Screen Door, for example, there's very clear kind of places where people looking to back underrepresented GPs, for example, at the time, would kind of gather, like the Equity Summit, for example. Like that was one of my favorite events, and I kind of knew a lot of who those LPs were. I think on the deep tech side, like I'm on group chats or constantly in touch with certain family offices, fund of funds, institutions that are focused there. And often we're going to some of the same events, some of the deep tech climate weeks, things like that. AGMs for larger funds or kind of known emerging managers that are getting closer to being established. But I don't think it's coalesced quite as well. A number of, kind of to your point, a number of sub $50 million, even sub $25 million funds that I liked and spent time with in my so far here at Astera were folks that spun out of Palantir or SpaceX, Anduril. So like you're starting to see those talent outflows mirror things like exoduses from Stripe or Mag 7 before that. But I don't think like the LPs are coalescing kind of concretely around deep tech nodes in the same way yet, which is part of, for me, a positive signal around the value of doing this and the alpha here to be had, where I can kind of help create some of those spaces and some of those conversations. And there is real benefit of me going to many LPs and being like, look, here's what I'm seeing, because it's not as clear where you can just go find kind of the latest and greatest pulse on that, or it's not as easy as some other sectors.
Wes, do you think that LPs who are interested in deep tech, frontier tech, have to be technical to underwrite these opportunities? That's the first question. And if not, what are best practices for them to get up to speed and kind of not have negative selection bias?
Yeah, you and I have talked about this before, and I've thought about this one. Because in the binary, no, because I'm not technical or not traditionally trained that way.
Yeah.
I think I flirted with neuroscience in undergrad for like a month, and I'll yeah, fair. So I'll just say quickly, I went to Johns Hopkins for undergrad with aspirations to be a doctor. I thought of myself as maybe a technical person, and I was also studying music, and so I wanted to understand how the brain would function in jazz music and improvisation, because I was a saxophone player and a piano player growing up. I had a neuroscience professor that walked up to the board and mapped out a timeline of how long it takes to get to med school, what you have to do, and I was like, absolutely not. Just absolutely not.
What a
So on the
gem.
binary-
That professor is the most valuable, like that was the best 3 minutes of your life, the most impactful.
I wish I should go find. I don't even remember this professor's name. I tell a story all the time, and you're so right. I owe him or her some flowers. I walked out and walked. Sorry, go ahead.
No, I was going to say, I have a I studied bio undergrad, so my friends are doctors and lawyers. And once a week, somebody calls me to be like, I don't want to do this.
And you're like, you're a doctor, ma'am.
That's exactly the validation I needed today. Thank you.
They say, is there a startup I could go work for? And I'm like, well, sure. Like, they're gonna ask
not-
you, like, would you like to do customer retention? Like, you're not gonna get paid what you're paid today.
Yeah. Better shot at being a consultant for the pit.
Yeah, that's right. So, I mean, so to answer your question, Ernest, I don't think you need to be technical, but I certainly think it helps. And I think if you are technical and your aim is to be a meaningful investor into a fund and also help catalyze a fundraise and crowd in other LPs, like you can really, like there is probably meaningful time left in the market for people to be playing from the LP seat or the allocator seat, that type of translation role. And one of the reasons I felt confident starting from zero with this narrow and specialized of a thesis was because there are so many technical scientists here at Astera. Some of my tips, if you're less technical and interested in the space, would be twofold. One of my colleagues at Astera has taught me to really embrace low status. So you have to be comfortable just asking what maybe feel like uncomfortable, obvious, or dumb questions. I find myself at Astera sitting in a room at any given day of 30 to 40 scientists who are experts in their field in energy, nuclear, AI safety, mechanic, like all kinds of things. And every day at lunch when we all sit, I'm just sitting in the corner being like, what does that mean? What does that mean? What does that mean? But I had to be honest, like, I don't think a lot of people are comfortable doing that. And for me, like coming in where I had clear expertise and confidence in being an allocator, and I had done it for years, it was like a foreign motion to go back to, I know absolutely nothing. It brought me back to my consulting days. So that would be tip one. And then tip two, which probably sounds obvious, but I will say has become invaluable to me, is to take relentless notes and then talk to AI all the time. So however, like through whatever medium, for me, that has been admittedly like voice. Like I will go home and I'll be working out and I will be like coming off a conversation with the founder or a scientist at Astera working on, let's say, fusion again, and be in my home gym like, okay, how many protons a neutron is in boron? And what role does that play in a nuclear reactor core? Again, like I can't remember, and just iterating and having the conversation. So it is the type of thing that I think if you want to be a good technically enough savvy investor in the space, you really have to cultivate an ability to ask shameless questions and like pursue understanding, and probably have requisite confidence before that in the allocator side of the job, at least enough that you can kind of like eventually over time marry those things together. That's the bet I'm taking here and on myself. We'll see how it goes, but that would be my advice.
So somebody who maybe does have a PhD, is very academic, but is also very charismatic and is a good teacher and can explain things in a really simple manner, especially when they're in front of like a generalist or somebody they're trying to sell to. Do you feel like the same thing is needed with deep tech fund managers?
I think I have biases towards those qualities. And the ideal for me would be similar to what you just outlined. Someone that is deeply technically trained, often a PhD, and also has the charisma or the depth of experience to explain those concepts simply and modulate those explanations to different types of groups in an effective way. The reality is those are pretty rare profiles. And I bet if I tagged the few hundred GPs I talked to at Astera so far by whether I think they have one or the other or both, it would probably bifurcate towards like one or the other. And so a lot of the value for me of meeting people in person over like extended amounts of times, or meeting people in person over extended amount of time, is to try to suss out like which one of those do I think they're stronger or weaker on, and do I think there is some path that they're seeking to close the gap enough on the part that's weaker. And it tends to be more finding the technical people that have enough of the seed of kind of charisma and understanding of venture. I think that's like easier to learn. Or I probably bias towards people starting with a technical advantage because it just crowds in better networks, deal flow, and then the rest you can learn. But I don't want to minimize that it's like easy to learn the venture or the charisma side. Like it's not, but that would be my personal bias. But I'll leave you with one example on this question, which is the first fund I backed was a GP who spun out of Google DeepMind, but within the DeepMind universe, he was not kind of as technical as some of the lead engineers. He led a safety team there. And a lot of what I liked is once he left, he just put his head down and kind of wrote about this on a series of Substack posts online about really educating himself on like the true technical parts of machine learning and LLMs, and has like all these posts you can follow over this like 1 year of deep dive. So that's like an example where I was like, oh, he just inherently wants to learn this stuff and is self-aware enough to know here's the moment that I need to level up in whatever area. So I think you can compensate, but my bias would be like probably technical people first.
For GPs who are listening, who are thinking, maybe I'm a match, maybe I should try to get an intro to Wes, any other qualifiers that are just basics, like you should speak to Wes in these cases, otherwise knock on other doors?
Yeah, I'll say maybe just like the straight ahead parameters. Right now, I'm preferring smaller funds. So usually funds $100 million or lower. So far, I've really only backed funds at like $50 million or lower because I think for many reasons. So that would be one. Usually a fund 1 through 3. Ultimately, we are very flexible, but that tends to be the sweet spot for fund investing. I like to talk to GPs earlier in their fundraise, and right now I'm preferring specialized funds, particularly in the following areas: AI infrastructure, energy, neurotech. Those are the main ones, but I'll talk to most people at least once.
That's awesome. Well, Wes, it's been a pleasure to have you on. Well worth the wait of having you on. The story is rich, and we can't wait to have you on in a year or two to learn kind of other learnings that you've had after setting the foundation for Astera. So thanks for being on Swimming with Allocators.
You're welcome. Thank you both. I'll be sure to bring my saxophone for the next one.
See you later, allocator.
After Portfolio Tile, investing with a smile.